If you don't understand market structure, you are not trading. You are guessing. And that's exactly why most traders lose money. Not because the market is hard, but because they never learn how price actually moves. This is a common problem. Most beginners start the same way. They open a chart, add indicators, watch YouTube strategies, and then try to copy trades. But here's the problem. They don't understand context. So they enter trades without knowing who is in control, where price is likely to react, or whether the setup even makes sense. That's why results feel random. What is market structure? Market structure is simply the way price moves over time. Think of it like a map. Instead of looking at random candles, you start seeing patterns in movement. It tells you three important things: direction, control, strength. Direction: is the market going up, down, or sideways? Control: are buyers stronger or sellers stronger? Strength: is the move clean or messy and weak? Once you understand this, you stop reacting to candles and start reading the story behind them. The three market conditions. Every market moves in three main conditions. Let's break them down clearly. 1. Uptrend. An uptrend is when price is moving higher, but not just randomly higher. It creates higher highs and higher lows. That means buyers are stepping in earlier each time. Key idea: you don't buy at the top, you buy during pullbacks. 2. Downtrend. A downtrend is the opposite. Price creates lower highs and lower lows. Sellers are in control. Key idea: you don't sell after a big drop, you sell during small rallies. 3. Range sideways market. This is where most beginners lose money. Price moves between support bottom and resistance top. There is no clear direction. Key idea: avoid trading the middle, only trade near the edges. Why market condition matters. This is one of the biggest mistakes traders make. They use the same strategy in every condition, but that doesn't work. Example: trend strategy in a range leads to false signals. Range strategy in a trend leads to losses. So before every trade, ask, what type of market am I in? This alone can improve your results massively. Swing highs and swing lows. Now let's simplify structure even more. Everything comes down to swings. Swing high, price moves up, stops, turns down. Swing low, price moves down, stops, turns up. These swings create the structure. If swings are going up, it's bullish. If swings are going down, it's bearish. Important tip: focus on clear swings, not tiny movements. Small noise equals bad decisions. Break of structure. This is where things get interesting. Example: in an uptrend, if price breaks below a higher low, that's a signal buyers are losing control. It doesn't always mean reversal, but it tells you, be careful now. This helps you avoid entering at the wrong time. Impulse versus pullback. Price doesn't move in a straight line. It moves in waves. Impulse equals strong move in one direction. Pullback equals small move against it. In a strong trend, impulses are powerful. Pullbacks are controlled. In a weak trend, moves are messy. Pullbacks are deep. Pro tip: you enter during pullbacks, not during impulse. Higher time frame. This is where most beginners get trapped. They only look at small time frames, but the bigger time frame controls everything. Example: 5-minute chart looks bullish. Daily chart is bearish. Who wins? The higher time frame. Always start from the bigger picture. And this is exactly why I created the Trading Master Ebook. Because most traders don't fail due to lack of effort. They fail because they never learn the foundation. Inside this ebook, I break everything down step by step: market structure, price behavior, support and resistance, risk management, trading psychology, so you can stop guessing and actually understand what you're doing. If you want to become consistent, start with market structure. Get the ebook from the link in the description and start trading the right way.